Professional skepticism. Professional skepticism refers to an auditor's questioning mindset towards representations made by management and the evidential matter gathered. So we are, as auditors, we are taking in representations made by management, we're collecting evidence, and then we're comparing the evidence to the assertions that were made. So what we say with professional skepticism is a little bit loose, but there is a task force working on it, so hopefully we'll be tighter on this in the future. But the basic idea is that inquiry alone is never enough. The auditor must obtain sufficient corroborative evidence that corroborates what management is telling us. Unusual financial trends need investigation. Documents are always checked for authenticity and for possible alteration. And we ask questions, we get answers, and then we verify the answers. So we must be skeptical because a potential conflict of interest always exists between the auditor and the client. The management tends to want to portray the company and its operations in the best possible light, and we want to make sure that the portrayal is fair and accurate. So let's practice our skepticism a little bit. That says the management wants to portray the company and its operations in the best possible light. So, just because I said it and because it's written there, do we believe that? Management wants to portray the company and its operations in the best possible light. When is that not true? So we think about, in the case of what's known as sandbagging, sometimes when a new management team comes in, they don't want to portray things in the best possible light. In fact, what they want to do perhaps is to portray things in the worst possible light, so that when things get better in the future, they can take credit for things getting better. So we should always assess what it is that management might be trying to portray. Don't always assume that they're trying to portray things in the best possible light. We need to make sure that they are not skewing things one direction or the other. Professional judgment process means we're going to clarify the issues and the objectives. We're going to consider the possible alternatives, gather evidence that's relevant, reach an audit conclusion, and then document the rationale. A systematic process, not too different from the ethical decision process that we talked about earlier. Now, in this particular process, do we always follow this sequence step by step? Clarify the issues, then consider the alternatives, reach the conclusions, document the rationale. We certainly should do the first three steps before we reach an audit conclusion, and then documenting could be done along the way or could be done at the end. Almost all auditors are going to document as they go. All right, in public accounting, we've talked about assurance and auditing services. We've got financial statement audit engagements. We get assurance engagements and attestation engagements. The two new ones that we've not talked much about are compilations and reviews. When we perform audits, in the United States, audited SEC companies, those companies that are required to report to the SEC, have to provide quarterly financial statements in addition to annual financial statements. So at the end of the year, they provide an audited financial statement. At the end of the first quarter, second quarter, and third quarter in the United States, they provide financial statements that they have reviewed by the public accounting auditing firm. Reviewed rather than audited. A review involves a limited set of audit-like procedures, and those are performed quarterly. I say in the United States they're performed quarterly because in many other parts of the world those are prepared only on the half year. So they'll have a half year financial statement and a full year financial statement. In the United States today and for a number of years we prepared end of year and quarterly financial statements. But reviews are limited procedures similar to audits. A review is almost never undertaken alone. Reviews are undertaken in concert with doing audit engagements. So rather than auditing each quarter and charging the client for an audit each quarter, the clients are happy because the SEC allows it to have an audit once a year and have limited procedures conducted on the at the end of the first, second, and third quarters. A compilation is a different service, sometimes referred to as a write-up service. A compilation is not bookkeeping, it's not auditing, it's not reviews. It is compiling the client's financial records into financial statements and formatting those in accordance with GAAP and including all the disclosures that GAAP requires. So we refer to that as compiling the financial statements. Many bookkeepers are not qualified to do compilations because they don't understand all the ins and outs of GAAP and all the disclosures, while they may be able to get the debits and the credits right and actually end up with ending trial balances that are perfectly appropriate for preparing the financial statements. When we perform compilations, we need to make sure that the client understands we are not providing audit or review services, we are providing compilation services. And so there's standards that suggest that we should have engagement letters that say clearly this is not an audit, this is not a review, this is a compilation, and described for the client, so make sure that the client understands what are the procedures that we're undertaking. So we have in public accounting, we've got three sectors. We've got assurance services. Typically, we refer to those just simply as audit or audit and assurance services. We got tax services, and we got consulting and advisory services that also are fairly broad. Let's talk about the structure, the organizational structure of typical public accounting firms. It's common to have folks that are dedicated to tax services, folks that are dedicated to audit and assurance, and folks dedicated to advisory services. And typically a partner in a public accounting firm will be either a tax partner, an audit partner, or a consulting partner. The audit firms will have practice offices, so you could think about Ernst & Young Dallas as distinct from Ernst & Young Houston, potentially Ernst & Young San Antonio, and then they will have a headquarters. Almost all the large multinational accounting firms have headquarters in New York City. So within the different areas of providing services, we have partners. Now the terminology is a little bit different. It's grown up because we started off with all general partnerships for public accounting firms. That changed around in the early 1990s. Texas began to allow some limited liability corporations to be formed to hold accounting practices. And so we don't, technically not everybody that's in that kind of a role nowadays is a partner, but most of the firms have hung on to the traditional terminology of partners. Below partners we have managers, and below managers we have seniors and staff accountants. So we can think about first year persons being staff accountants. In some cases they're referred to as associates. After 2-3 years, in many cases, a staff accountant will become a senior and will take on some supervisory responsibilities over staff accountants. Managers will, few of the seniors will hang on and become managers. In some firms it takes 7 years, and others it takes more like 12 years. And then introduction into the partnership is another major step, another major milestone in careers. Organization of the profession. We've got these days we have the big four accounting firms. At one time it was the big eight. The big eight has become the big four through mergers and through the loss of Arthur Andersen. The rest of those firms merged. So PricewaterhouseCoopers used to be Price Waterhouse and Company and Coopers and Lybrand, two firms roughly the same size, merged and became PricewaterhouseCoopers. Ernst & Young used to be Ernst & Ernst, or later it became Ernst & Winnie. It merged with Arthur Young and Company, and so it became Ernst & Young, or EY. Deloitte has dropped the name Touche. It used to be, for a while it was Deloitte Touche, because it was a combination of Deloitte Haskins and Sells and Touche Ross. And so those big four firms are the outgrowth of the successor firms to combinations that have been made along the way. We've also got Grant Thornton, BDO, McGladrey, and others. And in the Blackboard site, you'll see a number of other firms listed, as well as a breakdown that shows you kind of the Southwest regional breakdown of firms. Here they've listed just 3 firms, one being headquartered in Houston. Below the local and regional firms, we have at the smallest level is the sole proprietor, a single CPA operating without other CPAs in the office. So not an N company, but just a single CPA. And we have in the Dallas-Fort Worth area, we have quite a number of, well, all the big 4 represented, many of the national firms, and several large regional firms headquartered in the Dallas-Fort Worth area. Let's take a look at the big 4 just to get a sense for the breakdown of revenues. This breakdown of revenues is not the same across all firms, of course, and not the same from the big firms to the small firms, but there is some degree of consistency. We could see $31 billion in revenues. These are rather large multinational organizations. The breakdown here, audit and assurance services, 41%, 45%, 45%, 47%, so somewhere in the 40% range. Not 50% of the revenues, but an awfully significant portion of the revenues. Tax revenues, closer to 1/4 of the revenues are tax revenues. So significantly smaller than the audit revenues, but we can also see consulting and advisory revenues are rather large as well. All right, so Sarbanes-Oxley prohibited certain professional services being provided to attest clients. So if you're with a firm that provides attestation services to companies that are covered by Sarbanes-Oxley or roughly covered by the SEC reporting requirements, then you are prohibited from providing certain services to those firms. Specifically, you can't provide bookkeeping services to those firms. Those firms, if they have to report to the SEC, they are in general large enough where they have their own accountants and they don't need bookkeeping services. So item 1 is not a particularly significant loss of work. The design or implementation of financial information systems was a very critical one. Arthur Andersen made a large part of their practice implementing financial information systems, and it did that for many of the companies that it turned around and audited. Congress felt like when they passed Sarbanes-Oxley that it did not make sense to design and implement financial information systems within an organization and then turn around and audit those financial information systems. And so now you can do the audits or you can design and implement the financial information systems, but you can't do it for the same companies. Appraisal and valuation services, if it's strictly appraisal and valuation services, those cannot be provided by the audit firm. Likewise with actuarial services. There were instances where organizations were using their public accounting firm, audit firm, for internal auditing services, for outsourcing their internal audit, or basically contracting to get their internal audit work done. The Congress said with Sarbanes-Oxley, that's not going to be acceptable going forward in the future. Legal services unrelated to the audit are now prohibited. And then we've got this additional restriction on certain tax services. It used to be fairly common that you'd pick up an audit client. You would also pick up a lot of tax services and tax services to some of the executives. There are certain restrictions on that now that Sarbanes-Oxley is in place. Okay, in addition to financial statement auditing, the one that we talked mostly about in this class, performed in the United States by certified public accountants, CPAs, we've got operational audits. And operational auditing is very different. It's a way of looking to see if the operations of an organization or a subset of the organization are efficient. So you can think about this as being related kind of to industrial engineering, efficiency auditing, and definitely some of the tasks cross over into other areas other than things that we would think about as traditional accounting services. We've also got compliance auditing to make sure that there's compliance with governmental rules. And then we've got an area of forensic accounting that includes fraud examination, most notably nowadays certified fraud examiners. Becoming certified, today we recommend that all professional accountants that want to remain professional accountants obtain one or more professional certifications. The most prominent one, the most prestigious one, is the Certified Public Accountant. It is very challenging to obtain. There's also the Certified Management Accountant, Chartered Global Management Accountants, Certified Fraud Examiners. There are a number of, and Certified Internal Auditors. There's a number of different certifications. If you want to become and maintain your status as a professional accountant, it's important in today's economy to obtain certification. To become a CPA, the requirements are actually fairly involved, so that's the easiest one to think about because it typically has more requirements than becoming a CMA or CGMA or one of the other certifications. The requirements in Texas to become a CPA, and I say in Texas because each state has their own requirements. In Texas, there's a number of overlapping requirements, including holding a bachelor's degree and 150 hours, semester credit hours of college education. So education has to be done, and in Texas, you cannot sit for the CPA exam until you've got the education requirements met. There's additional education requirements like you've got to have 30 hours of upper division accounting classes. You have to have a couple of hours of business communications and so forth. In Texas, you have to have 2 years worth of experience to become certified as an accountant. And once you become certified, then you obtain a license from the state of Texas and have to pay to maintain that license each year, including obtaining continuing education each year to maintain your licensing. The Uniform CPA exam, I say Uniform CPA exam because it's the same CPA exam for every state in the union. They coordinate on that. It's organized through the Association of State Boards of Public Accountancy so that we don't have a different exam in Louisiana, Oklahoma, Texas, Arkansas, and so forth. The exam is the same. Some of the other requirements differ across the states. Texas requirements are among the most stringent in the country. The CPA exam was revised in 2011. It was revised again in 2018. It's a computerized exam. It consists of 4 parts. It takes 14 hours in all to sit for the exam, and the 4 parts are organized kind of around different conceptual areas. It's comprised of 2 different types of question sets. We have multiple choice questions, and there's task-based simulations. Task-based simulations you can think about as solving problems, and it's broken down. Each of the 4 parts has a different set of timing and a different set of requirements. So when you get ready to sit for the CPA exam, you'll spend a fair amount of time understanding what's coming up, so that you can, among other things, do a very strategic time management on the CPA exam. 4 parts for the CPA exam. The CMA exam is 2 parts. To sit for the CMA exam, you do not have to have completed your education. In fact, there's no specific education requirement to become a CMA. You do have to have experience, but to pass the exam, you just have to be able to pass the exam. You don't have to have the education in advance. And so the typical recommendation for students going through a 4 or 5 year program in accounting is to begin to sit for the CMA exam before completing your studies and sit for the CPA exam as soon after completing your studies as possible while the information is still fresh for you.